Hey everyone, welcome back to the channel. In today's video, we'll talk about something called as an alpha game and why Warren Buffett loves these index funds and these alpha games. Hey investor, today we are diving into an incredible story that shook the Wall Street market. So this was between Mr. Warren Buffett. In fact, it was $1 million bet between Warren Buffett and a hedge fund manager. But most importantly, we'll learn why this bet matters to every investor in the market. So this is like in common to everyone in the market. So imagine this, in 2008, Warren Buffett makes a bold challenge. He just makes a declaration in the open market. He says that he will pay $1 million to hedge fund managers or anyone of that matter who can make an exclusive investment vehicle that will make them wealthy over a period of 10 years. In fact, more than 10 years. If they are able to beat the index funds in 10 years' time, he's ready to pay them $1 million. So that was his claim. So at that time, a brave hedge fund manager named Ted Sides, he stepped up forward for this challenge. And now in 2015, just fast forward to that, he just threw up a white towel. He said that like he is not able to take up this challenge and he just gave up even before like 10 years time. But why did he do that? What made the one of the most finest hedge fund manager admit defeat? So for that, you need to understand the basics of the index funds. So to understand this David and Goliath story, let's try to make out some important concepts of your index fund. So think of an index fund is like it's a mostly a list of stocks. So think it in like a Spotify's term, like a playlist of all the stocks. Just like how Spotify's top 50 represents the most popular songs, indexes also, like the S&P 500 in the US or the Nikkei in the Japan, they also represent the country's biggest stock market indices. So now imagine like Tokyo's is bustling, one of the favorite tracks, and whenever you are moving different directions, you will be able to see different patterns of them coming up. So that's similar to how an index fund works. So simply to follow these index funds, you can easily correlate them with the playlist. So instead of you're trying to outsmart the market, you can try going up with your default playlist or with your default index funds. So the birth of index funds, that's how it all started. So back in 1976, when ABBA was in fact one of the topmost charts in the music industry, they were making up a financial product in the stock market industry. So that was the first time an index fund was formed. It was created by John Bogle. So his idea was very simple and it was very powerful. In fact, his ideology was like, why should we pay expensive fund managers when you could just simply buy the whole market itself? So that's where the alpha chase started. And that's how things will get really interesting hereafter. So in this investment style, we have something called as an alpha. It's like adding up extra spice to your returns. Say for example, you are getting, a market is giving you a 12 to 14% of return. And if your investment is able to make out 16 to 20%, then that 2% is what is your alpha. So you get a 2% of alpha. It's what every fund manager dreams of achieving. So every mutual fund or whatever it is, they just try to attain that extra alpha. That's what adds up credibility to their fund management. So the main thing that comes into picture here is your efficiency factor. Let's try understand this in a different way. And markets are simple like a Formula One races, extremely efficient with the information spreading at lightning speed. That's how market works. So this makes finding alpha really hard. Like in fact, it is like looking out for a taxi in the monsoons in Chennai or in Mumbai. That's how it is. So imagine like in emerging markets like India, the BSE or your NSE, also in Brazil's Bovespa, if you could see that this inefficiency in game where not all the players have the same information at all the time. So different people try to get the information in different variants, and that's where the alpha is getting generated. So when you take the global perspective of this, from London to Shanghai, the market efficiency varies. So while Warren Buffett suggests index funds for the US investors, the story might be different in different parts of the world. In India, for example, many mutual funds still manage to generate alpha thanks to the market inefficiencies. Because of that, they are able to manage out or like add up that extra alpha where they're able to beat out the index funds and they're able to create that additional extra percentage of growth when it compares to your market. So the bottom line of this is like, where exactly is your investing strategy? Like how are you planning up your investment? You could be like investing in your New York funds or in your Tokyo funds and stuff. The market inefficiency is something which you need to understand. That will give you a better edge or creating that additional alpha. So if you're highly efficient in the market like the one Mr. Warren Buffett, whose wisdom is about index funds, that might be your best bet. So, but remember, even in less efficient markets, generating consistent alpha isn't easy. So it's like trying to find out perfect thing. It takes a lot of skill, patience, and sometimes even a lot of failures too. So if you're still learning, don't worry about beating the market just yet. Just try to go with your index funds and try to get up that additional growth which your market is able to give. Even if you get 1 or 2% of additional alpha than your index funds, that's one of the best things which you could do. So what do you think about these investments versus your active investing in your country? Do let me know in your comments below. And if you like this video, remember to like it, subscribe to this channel, and click on that notification bell to stay updated on such more market investment insights. And I'll catch you up in the next video. Until then, stay tuned. Thanks for watching.